Welcome back to the Financial Freedom Show. My name is Rob Berger. In this episode, we're going to be talking about lump sum investing versus dollar cost averaging. It's a question I got from a good friend earlier this week, and some viewers have actually reached out to me and asked about this. They've come into some money. We kind of know the markets are somewhat overvalued, richly valued. We kind of wonder when the next crash is going to happen. And they want to know, do I put it all to work? Whatever my asset allocation plan is, do I just take this lump sum and put it to work now? Or do I spread it out over 6 months or 12 months or 2 years? What's the better approach? This is something I had to answer about 3 years ago when I sold 3 of my websites. I came into some money. What do I do? I'll talk about that in a bit. But it's an important question whether you're talking about a tax refund you want to invest, maybe it's a bonus from work, maybe you inherited some money, or like me, as you're getting, gray hair, closer to retirement, and maybe you sell a business, what do you do with the money? And so what I want to do in this video is walk through 8 things that I think we should consider. Now, it seems like a lot. We're going to go through them pretty quickly. It's all pretty, I think, straightforward stuff, but it's a really important question, and we want to give this a lot of thought before we make our decision. So let's get right to it. 8 things. And the first is, we can never know the answer in advance. We can never know in advance whether investing all of the money right now, lump sum investing, will end up being the best result. Or let's assume we spread it out over 12 months, over a 1-year period, whether that's going to be the better result. There's just no way to know in advance which one is going to turn out to put more money in our pockets. And I think it's important when it comes to investing that we understand the limitations of our knowledge. You watch some of these shows on investing, CNBC or Market Watch, whatever. And I would love for some of the folks that come on and get interviewed in response to some of those questions to say, I don't have the foggiest idea what the market's going to look like a year from now. That would be the honest answer. In any event, we cannot know. And so we shouldn't beat ourselves up over not knowing, nor should we sort of trick ourselves into believing, oh, we can figure this out. You can't. So that's the point 1. And actually, the next 2 are related. So the second point, it may not be quite so intuitive, and that is this. Even if we knew a year from now where the market would stand, we still wouldn't know whether lump sum investing or dollar cost averaging would end up with the best result. Now, that seems counterintuitive, so I kind of want to walk through that with you. And let me show you my iPad here, and let's sort of just draw it out. So let's imagine we start here, and the market is, and by market we can assume the S&P 500 or whatever you'd like, and it's at the price it is today. And let's go out 12 months, and let's just we'll assume it goes up 10%. All right? We're going to assume that we know in advance that the market will be up 10% a year from now. Should we dollar cost average, or should we lump sum invest? And one might initially say, well, lump sum would be the better outcome because we know it's gone up, right? If we knew it was going to go down 10%, right, then one might think, well, we want a dollar cost average. But in our hypothetical, it's going up by 10%. So lump sum investing, and we're sort of guaranteed our 10% gain. The problem with that is that we don't know how it's going to get from the beginning to the end, right? It could be a more or less a straight line, kind of like this, pretty non-volatile market. And in that case, yeah, we probably would want to put all our money in up front and just enjoy the nice steady gains for the year. The problem is it may not work out that way, right? It could either go sky high and then come down throughout the year, or it could crash. This is kind of like 2020, and then make its way back up to a 10% gain. And those are 2 very different outcomes. When we think about dollar cost averaging, for this first scenario where the market goes up, we're buying here and here and here and here, right, each month, right? I don't know if that's 12 slashes, but you get the idea. Well, in that scenario, yeah, we'd rather put our money in, right here, lock in that price rather than paying these higher prices, right? On the other hand, what if it turns out that the market did this, kind of like last year? Well, in that event, we probably would want a dollar cost average, because rather than locking in at this price up here, we can get the benefit of these lower prices as the market goes down, right? And then eventually ends up 10% higher. So even if we know the outcome of the market for the year, that still wouldn't tell us which approach we would work out better for us. And by the way, the same is true if we assume this negative 10%, because again, it could get there by going up first and then down, or it could go really low and then kind of recover at least to that point. Again, whether dollar cost averaging or lump sum investing would be better would depend entirely on whether it took this route or it took this route, right? And we cannot know that in advance. That's really point three, illustrates point three. Even if we think the market's overvalued, and I think many people do, and even if we're right, and a year from now the market's down 10% or 20%, or pick your number, that still won't tell us which one is better, dollar cost averaging or lump sum investing, because we don't know how it's going to get from where it is today to where it might be a year from now. So I can't stress enough, we do not know which approach will result in more money. Now those first 3 points might have you feeling a little frustrated. It's like I'm watching this video to get an answer, and so far, Rob, all you've told me is we don't have an answer. Well, we do have some things that can at least help us think through the best approach. And the first thing is actually a study, and I'll show it to you on the screen. I will leave a link to this study in the notes below. This is a study, obviously, by Vanguard. It was actually dated in 2012. I think it's as current today as it was then. And here's what they did. They compared dollar cost averaging to lump sum investing, and they did it in a couple of ways. First of all, they looked at 3 different markets: the United States, United Kingdom, and Australia. That was the first thing. They then looked at rolling 10-year periods starting in 1926. This goes all the way back, almost 100 years, through 2011. So they're looking at very long periods of time, and they're rolling 10-year periods, and they did it monthly. So like the first one started in January 1926 and went out 10 years. The next one started February 1926, went out 10 years. So they were looking at over 1,000 scenarios, right? They looked at different stock bond allocations, so they didn't just focus on one allocation, although the 60-40 portfolio, 60% stocks and 40% bonds, does come into play here, which I'll get to in a minute. And they looked at what they did was they said, okay, for lump sum, that's easy. Just the money goes in right at the start of this 10-year period. For dollar cost averaging, one of the questions, if you're going to take that approach, is over what period of time are you going to actually dollar cost average? They looked at periods ranging as short as 6 months to as long as 36 months, right? And here's what they found. That at the end of the 10-year period, lump sum investing beat dollar cost averaging about 2/3 of the time, 67% of the time. And by the way, that was true whether they looked at the US, the United Kingdom, or Australia, and it was over 1,000 10-year rolling periods, again dating back to 1926. Lump sum investing beat dollar cost averaging 67% of the time. Now, if you just want to play the numbers, if you're a numbers person, and you're saying, I understand it may not work out this way, but I just want to, take the approach that gives me the best chance of having more money, then according to this study, and it looked over a very long period of time, lump sum investing would be your better approach. Now, some of you may be more concerned about losing money than you are whether you get every last nickel out of your portfolio. I get that. And so let me give you another stat from this study. And what they found was that during a down market, and this makes sense, during a down market, dollar cost averaging beat lump sum investing. And what they found was that with lump sum investing, it actually declined in value, the market value of the portfolio, 22.4% of the time. With dollar cost averaging, it only went down 17.6% of the time. So if your concern is not so much, maximizing every last nickel in your portfolio, but you're concerned about losing money, what this study would say is probably dollar cost averaging, but again, it's still a numbers game, right? There's no guarantee at the end of this rainbow. So again, in a down market, dollar cost averaging outperformed lump sum investing. Now, the fifth point is it didn't outperform a lot. When lump sum investing outperformed dollar cost averaging, we're not talking about a ginormous amount of money. Over the 10-year period in the United States, with a 60-40 portfolio, this is where the 60-40 portfolio comes back into play, I mentioned a minute ago. On average, lump sum investing beat out dollar cost averaging after a 10-year period by 2.3%. So I don't think we're talking about huge sums of money. Now, I'm a big believer that every basis point counts. So for me, 2.3%, even over a 10-year period, is still a lot of money. But I think it's important to frame the issue here. We're not talking, for most people, about life-changing amounts of money. In a way, I think that's good news, because it tells me that, yes, this is an important decision. We want to try to get the right decision that we're comfortable with. It's probably not a life-changing decision. And personally, if I can make as few life-changing decisions as possible, at least when it comes to investing, I prefer that. All right, so that's number 5. Now, number 6, I think maybe the most important point in all of this is you really have to consider the behavioral finance side of this, which is just a fancy way of saying your own emotions, your own fear, your own greed. Well, greed may be too strong of a term, but emotions play a big role in this. In fact, let me take you back over to the Vanguard study, and I want to show you a section here at the beginning. And it's right here. They make a really important point, and they emphasize this further in the study as well. But they say, look, but if the investor is primarily concerned with minimizing downside risk and potential feelings of regret resulting from lump sum investing immediately before a market downturn, then DCA, that's dollar cost averaging, may be of use. Of course, any emotionally based concern should be weighed carefully against both the lower expected long-run returns of cash compared with stocks and bonds, and the fact that delaying investment is itself a form of market timing, something few investors succeed at. So that was Vanguard's takeaway, and I think it's an important point, though. We really need to think about our emotions. It's something that Paul Merriman, many of you have heard of, a great, I think, financial educator. He's written many books, and I've been, in fact, talking back and forth with him this week. But this is a point he stresses. He goes, if someone sort of goes all in with some lump sum and then the market craters, it could really have a pretty negative effect, not just at that moment, but for years to come in terms of their approach to investing. So again, that might favor dollar cost averaging. However it plays out for you, it's important to think about, I think, the emotional side of investing, not just the numbers, and not just, the percentages and the odds of which one might outperform. All right. The 7th thing, we got 2 more. The 7th thing is it's always important to consider your ultimate goals. I think this is really true for folks like me who had sort of a liquidation event later in life. I ended up not retiring, but I thought I was going to retire. I thought I was going to be living on that money the rest of my life. That kind of changes things. When you're 20 and maybe you inherit a little bit of money, you get a bonus from work, you got a long runway to deal with any mistakes that you might make. When you're my age and you've got this much gray hair, yeah, your runway's a little shorter, right? And so you don't have quite as much time to recover from some big mistakes. And so I think it's always important when you're making any financial decisions to always keep the end goal in mind. I think for a lot of us, it's having enough money, to retire on, whether you're retiring early, on time, late. And so if you've achieved that goal, they say once you've won the game, stop playing. I think it's worth keeping that in mind as you make this decision for yourself. The 8th and final thing I'll say is you should always have a plan. Now, I mentioned 3 years ago I sold 3 of my websites. I decided then, and it took me a couple of months. I didn't make this decision right away. I just put it all in. I talked to some advisors. They wanted to put me in very expensive real estate investments and black swan portfolios, and I thought about that. Not very long, frankly. And I said, no thanks. Vanguard index funds are just fine for me. Now, that was 3 years ago. Even then, I was worried that, the market's going to crash, it's overvalued. Of course, it did go down in the end of 2018, but here we are in early 2021. We've just, lived through and are still living through a global, once in a century pandemic. And the markets seem to just be doing fine. Of course, as I say that, I've probably just jinxed us, but whatever. The point is, I put all my money in right away. That was just the decision I made for myself. If you want a dollar cost average, I highly recommend that you come up with a plan, put it in writing, and stick to it. So, for example, you may decide to dollar cost average over 12 months. You're going to take 1/12 of your money, put it in each month for 12 months. Fine. Put that in writing, make that your plan, and then do it no matter what. Let's think back to last year, 2020. Let's imagine in January that was your plan. And in January, everything seems to be going just fine. February, not bad. And then March, I guess actually it started to go bad at the end of February. And then in March, just the floor fell out and we were in a free fall. Would you have stuck to your plan? 1/12 in March? 1/12 in April? Would you have continued that plan? I know I would have had second thoughts. I think many people would have. I hope I would have stuck to the plan if that's what I was doing back then. I think it's critical that whatever you decide to do, plan it out, put it in writing, and stick to it. That avoids the market timing that actually Vanguard warned about, right? And in fact, if we look back to last year, had you gotten scared and abandoned your plan, you would have come to regret it. Now, I know what some of you may be saying is, yeah, but Rob, that's just how things worked out. We could go through a similar situation, and instead of the market recovering as it did throughout the end of 2020, maybe it continued to go lower. You're absolutely right. That's really the point. We have no clue what the market's going to do. I don't know what it's going to do by the end of today, let alone next month, next year, next decade. And that's the point of coming up with a plan, writing it down, and sticking to it. I think we should do that with our asset allocation. We should do that with how we plan to rebalance. We should also do that if we choose to follow the dollar cost averaging approach with, if we get a lump sum amount of money that comes into our lives. So those are the 8 things I think we should consider. I don't think there's one right answer, but I think those are primarily the things you should consider if you're making this decision for yourself and your family. Listen, if you have any questions, leave them in the comments below. I'll do my best to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.